Hey guys, welcome to this lesson on indicators. So I wanted to just start off and introduce the indicators lesson and pretty much just say that there's one thing that I follow when it comes to indicators, and that is less is more. And you're gonna see my charts. I don't use many indicators at all. When you're gonna look at other technical analysts and look at their screenshots, you're gonna see potentially 20, 10, 50. I've even seen 100 indicators on one chart. And to tell you the truth, I don't know how people look at the charts like that. So for me, I don't like messy charts. I keep my charts very, very, very simple. And because of that, I only simply use 3 indicators, and the main one is the 50 EMA, the 50 exponential moving average. And you're gonna see that, so I just wanted to start off this video by simply saying that less is more when it comes to indicators, especially the way I trade. You don't need much, and I will teach you everything there is to know in regards to the indicators that I use. And then we'll continue with the other lessons talking about price action, which is the main thing that I actually use and not just the indicator. So with that said, guys, let's jump on the charts and I'll show you what I mean. All right, guys, so again, you see the charts here on the screen, and again, it's the same layout as before: monthly, weekly, and daily. Now, what we're gonna focus here is indicators. So when you look at my charts, you can see that they're pretty simple, pretty clean. There's not much going on, okay? It's just price action itself, which some of you who don't know what price action is, that's the actual candles, that's the data, okay? So that's price action. Now, when it comes to indicators, I don't use much. When you're gonna look at, sometimes you're gonna see other people's charts and there's hundreds of indicators. I don't even know what they're looking at, because there's so much going on. And when you rely, to me, my analysis is in a way that I do not rely on indicators. I can trade without 0 indicators, but they're a nice tool, the ones that I use, because they complement my strategies really well. Okay, they're not useless. That's the thing. I find that a lot of people use so many indicators that are just useless. You don't need them. Many of the indicators tell you the exact same thing, as an example. Okay, so like I said, for me, I don't even need to use indicators. I can simply use price action analysis, horizontal lines, trend lines, and Fibonacci retracement tool. I can just use simply that and trade my strategies. But again, some indicators, specifically the 50 EMA, okay, complements my strategies really well. Okay, so I like to keep my charts simple. Now let's talk about the indicators. So the indicators that I use are as follows: the 50 EMA. Okay, so let me show you the settings for that. Again, every single charting platform has the 50 EMA, and what that is the the exponential moving average. Okay, so it's a moving average. There's many different types of moving averages, such as, simple and exponential are some of the most common one. A lot of people use simple moving average. I use the exponential moving average, meaning that the most recent data is weighted heavier, kind of thing. Whereas a simple moving average, everything 50 days and back is weighted evenly, okay? Whereas exponential moving average, if you go 50 days, because this is a 50 EMA, so 50 days back, if you're looking at a daily chart, it means that the most recent days are weighted heavier, okay? So it's exponential. So I find that that is a little bit more reliable because I want to know what's happening now, not what's happening previously, okay? So that's why I focus more on that. I want to know what's happening now, okay? So exponential makes more sense for me. So that's what I've always been using. And that is the only indicator that is required, literally. It's the 50 moving average. And this is how it's set up. So exponential length is 50. So the length, if you're looking at a daily chart, it's 50 days. If you're looking at a weekly chart, it's 50 weeks. If you're looking at a monthly chart, it's 50 months, okay? So sometimes, as an example, if you're looking at a stock where it still hasn't existed for 50 months, as an example, then the 50 EMA will simply not populate because there's no 50 months, there's no 50 candles, okay? Same thing for cryptocurrency. If you're ever looking at cryptocurrency and you're looking at the 50 moving average, and that currency maybe hasn't even been out for 50 days yet, then the 50 moving average will not populate because, it's not around yet. Okay, so that's just something you need to be familiar with. But 50 moving average is the one indicator that is required, and it's not that it's required, but it's very helpful when it comes to the way I trade. The next indicator is the 20 EMA. Okay, and the 20 EMA I mainly use it for target purposes. And what I mean by that is I will simply use it for targets. So if I'm ever playing the pullback or trading the pullback, the 20 EMA is going to be a target level for me. That's it. Okay, but it's the same indicator as the 50 EMA. It's the length of time is only 20 days or 20 weeks or 20 months. Okay, so it's a little bit short term. It's more short term, but it's the same thing. It's a moving average set to exponential, and 2020 is the length of time. Okay, so again, this one is not required, but I use it for targets. It's helpful for targets. Now, when we go to the intraday levels, I don't use the 20 EMA on the intraday charts. Okay, because when it comes to the intraday levels, to me, it's not that reliable. Okay, even for targets. So I only use the 50 EMA. That's why I said 50 EMA is the main indicator I use, and that's it right there. So I use it on every single chart, even on the 5-minute time frame. Okay, and you will know more how I use it when we actually dig into the full analysis. But what is an EMA at the end of it all? An EMA, or a moving average, is support and resistance. It is dynamic support and resistance, meaning that it will act as resistance like it did here. Okay, price action broke down and then pulled back, and it started rejecting the 50 EMA. So the 50 EMA is now it's now acting as resistance in this case. Okay, if we go here and zoom in a little bit, you'll notice that the 50 EMA acted as support. Okay, so that's what it's used for me. It's mainly used as dynamic support and resistance. So dynamic meaning that it changes all the time. It is not fixed. When you're looking at horizontal levels, such as, just drawing in a support and resistance level like this, horizontal support and resistance, here it is. Okay, this is a horizontal support and resistance level. And we will look at that later in the coming up lessons. But the difference is this one does not change. It is fixed. Okay, whereas the EMA is dynamic and moves around based on the trend. Okay, so that is that for the moving averages. The 50 EMA is the main one I use. The next thing you see on my chart is MACD. Okay, so when we look at MACD, this indicator, I took out, when you're looking at the settings here, I have took out the histogram and I have took out the signal, because to me that I don't use it. I don't need it for that. I don't use MACD for that. So I don't need the signal and I don't need histogram. Again, simple is more, less is more in my case. So what do I use MACD for? MACD for me is used to identify divergence in the market. Okay, so what is divergence? So I'm going to draw 2 lines and then I'm going to explain it, what I'm actually doing. Okay, so we got 2 lines here. We have price action on top, we have the indicator on the bottom. So you see how price action is moving down, a lower low, previous low, lower high, lower low. Okay, so the price action is still heading lower, but MACD is heading higher. As we had this lower low here on the chart, well, MACD gave us a higher low. Okay, previous low, higher low, and then the price action continued to give us another lower low, but MACD continued to give us a higher low. Okay, so this is divergence in the market. This means that MACD is supposed to follow with the trend, and it has been right here. So you can see right here, it's pretty much following the movement, it's following the trend. But after it made this low over here, MACD was still following the trend, but now during the second low, MACD did not continue. The MACD indicator did not give us a lower low, but instead gave us a higher low. And this gives divergence. And divergence means, when you see divergence in the market like this, it means that at some point, this is the most important thing to note when it comes to MACD, is this: at some point, period. At some point, price action will turn around. Okay, Now this might continue for weeks. I've seen MACD show divergence for weeks, but it means that at some point it will turn around. So because of that term, because of that statement, at some point, it cannot be used as the main indicator, okay? EMA can, the 50 moving average can, but MACD cannot be used as a main indicator. And what I mean by that is you have to do your analysis first, okay? So you use your 50 EMA, you use your horizontal support and resistance levels, which we will talk about in the next lessons. You will use your trend lines, and you will do your analysis first. You will make sure that your strategies fit, okay? So the strategies that I will teach you, make sure that the strategies fit, make sure everything lines up, and then look at MACD. You look at MACD at the end. It's kind of like the cherry on top of a cake, okay? So you look at MACD at the end, and then you'll say, okay, there's MACD divergence, perfect, it's a great time to buy or a great time to sell. When everything lines up, then you check MACD and MACD is giving you divergence, either bullish divergence or bearish divergence. At that point, it means good time to buy because everything is already showing you that it's going to go up. And then when you look at MACD, MACD is also giving you bullish MACD divergence, then it's a good time to buy. So it's an indicator that is used at the end. It's not something that you see MACD divergence like this right now. It doesn't mean you should be going long right now. It doesn't mean that you should be buying this right now just because you see MACD divergence. If you do that, you will fail. It's not going to work out for you because like I said, MACD can continue, okay? You have to rely on other technical analysis tools, which I will teach you, and then look at MACD divergence. So as you see, it's an indicator that you don't even need, but it's helpful. It gives you an extra edge when you have MACD divergence, and we want an edge. We want to make sure we have an edge in the market, meaning that, there's much more on your side than against you kind of thing, So it's a helpful tool. Now, when we go down to the lower levels, so again, you're going to see here on the intraday charts, I only use the 50 moving average, the 50 EMA, and MACD divergence. That is it. Well, now on a 5-minute chart, I do not use MACD. It's pointless. But what I do have here on the 5-minute chart is volume. So the volume indicator, simple. It's a simple volume indicator. It's here on eSignal. You have it on TradingView. You have it everywhere. Every single brokerage platform, every single charting platform will have this volume indicator. So volume will come handy with a few strategies, okay, specifically the advanced breakout strategy. And what volume tells us is, it tells us when there's a spike in volume, meaning that there's a lot of buying or a lot of selling, okay? So there's either a lot of buying positions being placed or a lot of short positions being placed, okay? So there's gonna be times when the volume is low. And let me explain that in a second. If you're trading a pair such as the Kiwi, okay, so New Zealand dollar, this is a New Zealand dollar pair. So if you're trading a pair like this, the volume for this pair will most often spike at the beginning of the Asian session, okay? During the New York session, during the European session, it might be a little bit slower. The volume might be a little bit less, or down, simply because during the Asian session, that is when the announcements will be placed for New Zealand or Australia or Japan. Those are all Asian pairs. So they will be more active during the Asian session. So you will see the volume start to spike at the beginning of the Asian session. If you're looking at a pair like the pound as an example, okay, dollar pound, you're gonna notice that, pound dollar, you're gonna notice that pretty much the volume for this pair spikes at the beginning of the London session. So this is the beginning of the London session, 5 a.m. London, 6 a.m. London, okay, 7 a.m. London. So you can already see the volume is spiking. And actually you will notice that majority of the pairs will spike at the beginning of the London session, okay, not during the Asian. Majority of the pairs will spike at the beginning of the London session. So here we have the Asian session right here. We have the end of New York, which is right here. This is the end of the New York session. And then beginning of the Asian session, you see the market is down. It's not doing much. Volume is down. And you can see the same thing in price action. It's not doing much. It's moving sideways. And until volume starts spiking, that's when the actual move happens in the market. Okay, so when we're day trading, this is most important when we are day trading. So when you're day trading, you want to be day trading sometime around the volume spike. So either when the volume is high or sometime just before the volume spikes. Okay, so that's the volume indicator. I use it. You need it on your charts as well, specifically for one strategy, which will be advanced breakouts. Other than that, let's talk about some other indicators that I do not use. One indicator that is very common is pivot points. Okay, so the pivot. Let me spend some time talking about the pivot. The pivot indicator, you can use it mainly on the 5-minute time frame. And it will be used for support and resistance. The pivot is pretty much support and resistance, but what it is, it's calculated based on the daily time frame. So based on the daily candlestick, the previous day, okay? So you see here, the main pivot. So we have the main pivot is the blue line, then we have support 1, resistance 1, okay? So the lower level is support number 1, the upper level is resistance number 1, okay? The main pivot is what you'll be using if you use the pivot indicator. And I don't use it simply because I use other analysis tools to plan my entries, such as Fibonacci retracement. That's the one you will be using most. That's the one I use the most. That's the tool that I use the most, is the Fibonacci retracement tool. So when creating this masterclass, I want to make it as simple as possible and eliminate anything that's not needed. The pivot is something that's not needed, because what you will find is that Fibonacci retracement tool will give you the exact same entry, but a little bit more refined even, okay? And I will teach you the Fibonacci tool in the coming up lesson. But pivots, you can use it, and mainly what you will be using it for is for entry purposes, you know, so you can measure your entry somewhere around the pivot, like this, you know, because the pivot is acting as resistance or support, okay? And we'll talk more about the pivot when we dig into the strategies. I'll show it to you guys in the strategies. But one thing that you also need to know about the pivot is how it's calculated. Okay, so it's calculated based on the daily bar. That's the most common, okay? When it comes to indicators, we want to use what's common, what majority of people use. Okay, so when it comes to the pivot, daily bar. You want to make sure it's calculated based on the daily bar, and then the calculation itself. Okay, so based on the daily bar, the high of the day, the low of the day, the close price of the day divided by 3, okay? So high plus low plus close divided by 3. That is the source that you want. That is the measurement, the calculation that you want, okay? And it's, again, calculated based on the daily bar. So that's it. Again, I don't use it. I used to use it quite a bit, but I also noticed that Fibonacci retracement gives me the exact same thing, even more refined than the pivots. So I simply, for masterclass purposes, and now in my own trading, I don't use the pivot. And I don't need to use the pivot because, like I said, Fibonacci retracement tool will give me the exact same, but even a more refined measurement. And that is it, you know? So those are all the indicators that you could use with my trading style, with my strategies, or with whatever I'll be teaching you. Those are the indicators that you can use. Extra indicators, I'm gonna speak about one extra indicator, and that will be RSI. So when we go and I'm gonna plot RSI in here. RSI stands for Relative Strength Index, okay? It tells you that the market is overbought or oversold. So I have it set here for the 80 and 20 levels, okay? So this is something you can again customize. But I have the bands, upper band as 80, lower band as 20. Everything else, this is how it's set up. RSI's length is 14, okay? So RSI itself, I don't use it. I never used it in my analysis because I find that it's pretty pointless. But it can be used in the same way as MACD, meaning that it's used at the end of your analysis, not at the beginning of your analysis. I find that people use it at the beginning of their analysis and it doesn't work that well. RSI is something that should be used at the end of your analysis, meaning that you already made a prediction, you already know that you're either going to be trading long or trading short, so buying or selling. And then at that point, you're going to check RSI and be like, okay, the market is overbought. So what does RSI tell you? Okay, let's look at price action here. Let's actually look at a different pair. I'm going to look at something that That's a really good example of RSI. Let's look at Kiwi. Okay, so we looked at Kiwi pair when we were looking at MACD divergence. Okay, can be, and let's have a look at it now with RSI. So right here, you see how RSI started to go up and up and up and up, and right now it's in the overbought territory. Right here, it crossed the upper band, so it crossed 80, which is my upper band. So when RSI crossed 80, it means that it's in overbought territory. Okay, and it stayed here for quite some time. But the first time it crossed the 80 band, if you look at right where price action is, it did not even pull back. Okay, this was not overbought, to me at least, because it didn't have a proper pullback. This is a proper pullback and it's still overbought. But that is why you cannot look at RSI and be like, as soon as it crosses, look for a short. You can keep an eye out for a short, but a lot of people, as soon as the RSI crosses, they're like, yep, I'm gonna place a short position now. That's not how it's used, okay? Right here at the end, when everything is, when the technical analysis in your strategy is pointing to a short trade, at that point you can check RSI to see if it's overbought. And if it is, then it's a good time to sell. Same thing right here, okay? So when it crossed the lower band, which is 20, once it crossed the 20 band, and you look at right above, price action, it was not oversold because it still continued to go much farther. So that's the thing, it's not the best indicator because it's still, price action still went much lower and it was still in the oversold territory, okay? And then it went up slightly after. But that's the thing, you know, it's not really, to me, it's not a reliable indicator, meaning that when you see that it's overbought or oversold, it does not mean that it's going to go up or it's going to go down right now. The price action is going to go up or go down right now. You still have to rely on price action analysis, okay? So that's the thing. These indicators, you can fully remove them off your charts, okay? And just use the moving average if you want, you know, because MACD and RSI, they're indicators that you can just use at the end of your analysis to kind of put the cherry on top of the cake, you know? So for me, RSI, I don't use RSI. I will simply just use MACD divergence for that point from the end of my analysis. And that is it, you know, that's the end of indicators. So RSI is just an indicator that's popular, that's common. You could use it. I don't use it. I don't think you need it, you know, for that specific reason. It's not really that reliable. And if anything, it can be just the cherry on top of your cake if you want, you know, so something at the end of your analysis that if you want to just say, hey, it has RSI, RSI is overbought, you know, if you just want to put another check mark to your strategy, you know, which again, when it comes to my trading, you do not need it. So that is it when it comes to indicators. Remember one thing, less is more when it comes to the way I trade. Less is more. And the only indicator that I need that is very, very, very helpful is the 50 EMA. Everything else is bonus, is extra, which is the 20 EMA and MACD. That's just extra, okay? But it's helpful. All these indicators, they're helpful, except RSI. RSI is something I will never use. It's something that you will never see in my trading. All right, so that is it for indicators. I'll see you guys in the next lesson.